Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. My goal is to help you put your money where your mouth is and invest in great companies. If you are like me, you love food and you love investing. So, it only makes sense that you will love this channel too. In this video we will be exploring Wingstop and analyzing if it would be a good addition to the portfolio. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. First, let's start with a bit of background information. Wingstop was founded as a chicken wing restaurant in 1994 and began opening franchise locations in 1997. Based in Addison, Texas, the company went through multiple private equity transactions, ultimately going public in 2015. Today the menu includes several different chicken options including wings, boneless chicken tenders, and sandwiches.
All I want is Wingstop!
That's a little excessive.
Let's now look at the price action. Starting with the 1-year chart, we see that Wingstop had a CAGR of about 30%. Zooming out to the 5-year chart, we see that Wingstop had a CAGR of 27%. Ridiculous returns. Great growth company. Let's explore the fundamentals, shall we? Gross margin is amazing at 48%. Revenue has compounded at 25% over the past 5 years, most recently hitting $390 million on a trailing 12-month basis. Really strong gross margin and revenue results. Love it. Looking at free cash flow, we see a 18% CAGR over the last 5 years, with capex increasing pretty handily at a 49% CAGR. Stock-based compensation is also growing at a 9% CAGR. I am not too worried about the free cash flow here, though capex is outpacing free cash flow growth. Free cash flow is nearly 18 times capex spending. Additionally, though stock-based compensation is growing at a fast rate, free cash flow is growing even faster. Next, weighted average shares outstanding are barely growing. This indicates to me that Wingstop is largely finished with the massive shareholder dilution often seen in early growth companies. Now, return on invested capital. Return on invested capital decreased during the period at a CAGR of about -5%, going from 34% in 2018 to 27% most recently. I am okay with this. While it is more desirable to have increasing return on invested capital, the current value of 27% is very strong. Cash conversion cycle, a measure of operational efficiency, is exploded recently, going from 0 days in 2018 to 15 days most recently. Wingstop is demonstrating a change in its inventory control. Scrolling down, we see that the days of sales outstanding is constant and the days of payables outstanding is constant, but the days of inventory outstanding has exploded to 74. They may have brought forward some of their inventory to head off rising costs. Last, let's explore Wingstop's debt metrics. For Wingstop, the current ratio is 3.1. The debt to equity ratio is 1.6, and the net debt to EBITDA ratio is 4.6. These values indicate more debt than I was anticipating and may become an issue if cash flows fall. So now that we know all about the fundamentals of Wingstop, should we add it to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's write out some key metrics for Wingstop. A gross margin of 48% is beautiful. Truly stunning. As mentioned in other videos, I like to start with gross margin because if this sucks, then no matter how great the other metrics, the company will be terrible. For Wingstop, this is clearly a great gross margin. The 5-year revenue per share CAGR is 24% and the 5-year free cash flow per share CAGR is 17%. Very nice. A return on invested capital of 27% is solid and shows very good efficiency. Next, the cash conversion cycle is 15 and seems to be due to rapid rise in inventory. Regarding the debt, a net debt to EBITDA of 4.6 means the company would take a little over 4.5 years of EBITDA to pay off its debts. That is a bit more aggressive than I would like. So from a fundamental standpoint, Wingstop looks good but is a bit heavily levered and has excess inventory which could lead to problems in the future. Last, let's look at valuation. Wingstop is way overvalued relative to the S&P 500 with a ratio of 3.1. Strong growth often commands a premium to the market, but this is really expensive. The price to earnings growth, or PEG ratio, of 7 reiterates that Wingstop is a bit pricey relative to its projected earnings growth. So, my final thoughts on Wingstop is that it is a strong growth company with a sizable debt load. The high valuation means I will probably wait for an even further drawdown to enter. I will keep this on the watch list, but it may be some time before Wingstop becomes a buy for me. Many thanks for watching. What do you think about Wingstop and its valuation? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.